Reporting entity and consolidation of less than wholly owned subsidiaries with no differential. We're going to look at an example through the initial acquisition, year 1 and year 2, when we have an NCI, or when the parent buys less than 100% of the investment. You see here the information that we're going to use. We have the parent acquiring 80% of the sub for $597,800, and then the NCI's value is assigned at $149,450. This information can be found on ReggieNet in the Excel spreadsheet under the blank section, and you can print this off and follow along if you'd like, or you can follow through the lecture notes. Both sheets or both sets of information are exactly the same. Our initial entry is going to be debit investment, credit cash, $597,800. Notice that we didn't do anything with the NCI amount. We won't do anything with that until we consolidate. Remember, during the year and with the investment, the parent is going to account for the investment under the equity method of accounting, which is what we're doing here. We need to compute our differential if there is any. In this case, there is none, but we're going to go through the process. We're going to now see that the NCI has an amount, so that 0 we've been putting in prior lectures is now going to have some value assigned to it. We see here the parent's purchase price, the NCI amount, and we get a total value of $747,250. And when we drop that into our differential computation, we can see that the fair value of the net assets is $747,250, and the book value is the same as well. That leaves us with no differential. If we break that down, we see the same information. There's no goodwill, no excess fair value, and the book value is our base amount of $747,250. We see that there's 0 excess value, and we see the book value. We need to do a book value computation. Again, that's going to help us with our EJEs as we progress through the initial acquisition, year 1 and year 2. The only difference between chapter 2, where we had the parent owning 100%, and in this chapter where there's an NCI, is that we allocate a portion of the subsidiary's equity between the NCI. In this case, we take the $337,250, the common stock, plus the retained earnings, add that up, and allocate that out 80% to the parent, 20% to the NCI. The biggest addition we're going to add in this chapter is that everything we do will be allocated between the parent at 80% and the NCI at 20%. Let's do the consolidation immediately after the acquisition. Here's our two-part worksheet, or our one-part worksheet here with the information ready to consolidate. The first EJ we'll do is the subs equity at book value, and we've got that information on our book value schedule. This information here is going to make up our EJE that we're going to need for our equity. Debit common stock, debit retained earnings, credit the investment sub, and the NCI. We've got those numbers from the book value schedule. We're going to post those to our three-part worksheet. It'll look something like this. What I want to pay attention to is two things. The first is the investment sub is now 0, which it has been in chapter 2. It should be at 0. The new thing that we see is at the bottom of the balance sheet, right below retained earnings, we have an NCI value. That NCI value came up from the 20% of the equity that the NCI has been assigned, and that comes up to $149,450, and you can see that we've added that to the balance sheet.